Right now, you probably have some money sitting in a savings account. Maybe it is your emergency fund or some money you have not figured out what to do with yet. And if you are slightly more informed than the average person, you might have moved it to what they call a high-yield savings account because the interest rate is better, and you feel pretty good about that decision. But here is the question nobody ever asks. If your bank is paying you 4.5% on your savings, where exactly is that money coming from? Because banks do not give away money for free. And the answer to that question reveals something about your savings account that most people never find out. Your bank is using your money to make significantly more than they are paying you. And the gap between what they earn and what they give you is one of the most profitable businesses in the history of finance. In this video, we are going to follow two people, Maya and Jordan, and one alternative that most people have never considered. We are going to look at the actual numbers behind your savings account, and by the end you will understand exactly what your bank is doing with your money and whether there is a smarter place for it to be. Maya works a regular job and earns a regular income. 3 years ago, she did everything the personal finance advice tells you to do. She saved 6 months of expenses and put it in a savings account at her big national bank. $20,000 safe, accessible, doing the right thing. Her bank pays her 0.38% interest per year. On $20,000, that works out to $76 a year. That is $6.33 every month. Not enough to fill a tank of petrol, not enough to buy a decent meal. But Maya is not worried about the interest because she has been told the purpose of an emergency fund is safety and access, not growth. Now here is what Maya does not know. The moment her $20,000 landed in that bank account, the bank put it to work. Not in a vault, not sitting there waiting for her. The bank took her deposit and used it to fund loans and investments that earned them significantly more than 0.38%. While Maya earned $76 that year, her bank likely earned over $1,200 using her money. She provided the raw material. They kept the profit. And she got just enough to feel like she was being looked after. The core business model of banking is simple to understand once someone explains it plainly. Your bank takes your deposit and pays you a small rate, in Maya's case 0.38%. They then lend that same money to someone else at a much higher rate. The gap between what they pay you and what they earn is called the net interest margin. And right now that margin is at its highest level since 2019. So where exactly does that $1,200 come from? It comes from three main places. The first one is credit cards. The average credit card interest rate right now is around 21%. Your bank takes Maya's money at 0.38% and lends it to someone's credit card at 21%. That is a spread of more than 20 percentage points on a single transaction. The second one is loans. Car loans are sitting around 7.5% and mortgages around 6.8%. Every single one of those loans is funded in part by people like Maya who deposited their savings and got back almost nothing. The third one is something called the Treasury trade, and this is the one that should make you pause. The bank takes your savings and buys short-term U.S. Treasury bills that yield around 3.6%. They earn 3.6%, they pay Maya 0.38%. And they keep the 3.22% difference for doing a trade that Maya could have done herself. The bank is not a vault, it is a middleman, and you are paying them more than 3% a year for the privilege of letting them use your money. Now meet Jordan. Jordan is the kind of person who reads personal finance articles on weekends and watches videos about money. He heard about high-yield savings accounts and spent hours comparing rates across different online banks. He moved his $20,000 to a high-yield savings account paying 4.5% per year. Compared to Maya's $76, Jordan is earning $900 a year. He feels like he has cracked the code. But Jordan has 3 problems he has not thought about yet. The first problem is what the banks call the promotional rate trap. Many high-yield savings accounts advertise a headline rate that only applies for the first 90 days or only on the first few $1,000s. After that introductory period, the rate can drop significantly, and Jordan may not even notice because the change happens quietly in his account settings. The second problem is taxes. Interest earned from a savings account is taxed as ordinary income, the same way your salary is taxed. If Jordan is in a 22% federal tax bracket and pays 5% state income tax, then his $900 win shrinks to around $657 after taxes. He started with $900. He keeps $657, and he did not know that going in. The third problem is the one most people never think about. Where does Jordan think the bank gets the 4.5% to pay him? They are doing the exact same thing Maya's bank is doing, lending the money out at higher rates and buying treasuries. Jordan is just getting a slightly bigger slice of the same pie. The bank is still keeping a significant cut, and Jordan is still the raw material. Being a more informed customer of the same broken system is better than being an uninformed one. But it is not the same as stepping outside the system entirely. Here is the question Jordan never asked. If my bank is taking my money and buying treasury bills to earn 3.6%, why don't I just buy the treasury bills myself? This is not a complicated idea. It is actually very simple to do. Short-term Treasury ETFs funds that hold U.S. government treasury bills are available through most standard brokerage accounts. One example is a fund called SGOV, which holds treasury bills that mature within 3 months. As of early 2026, these are yielding around 3.95%. On $20,000, that is approximately $790 in gross income per year. Now, at first glance, that looks like less than Jordan's $900 from his high-yield savings account. But here is where it gets interesting. Interest from U.S. Treasury securities is exempt from state and local income taxes. Jordan pays both federal and state taxes on every dollar his high-yield savings account earns. The Treasury investor only pays federal tax on the income. So when you run the full after-tax calculation for someone in Jordan's tax bracket, the direct Treasury route actually puts more real money in your pocket than the high-yield savings account does. You cut out the middleman, you keep the state tax savings, and you are lending directly to the U.S. government rather than to a bank that lends it back out at a markup. This is not a complicated hedge fund strategy. It is the same trade the bank was already making with your money, except now you are the one keeping the full return. Now, at this point, most people have 2 concerns, and both of them are reasonable. The first concern is safety. Bank savings accounts are FDIC insured up to $250,000 per depositor. But buying a treasury bill means you are lending money directly to the United States government. And in terms of the likelihood of getting your money back, the U.S. government has a stronger repayment record than any bank on earth. In many ways, a treasury bill is the safest asset that exists anywhere in the world. The second concern is access. A savings account lets you move money instantly at any hour of the day or night. A Treasury ETF in a brokerage account takes 1 to 2 business days to settle after you sell it. And that is a real difference worth acknowledging. But here is the honest question to ask yourself. When was the last time you needed $20,000 in cash within 60 seconds? For almost every real emergency in the real world, 48 hours is more than enough time to access your money. A medical emergency, a car breakdown, an unexpected repair, every one of these can wait 48 hours for the money to settle. And for that small inconvenience, you stop being the bank's cheap raw material and start keeping the full return yourself. So let us make this concrete for a moment. If you have $20,000 sitting in a standard savings account earning 0.38%, you are earning $76 a year. If you move it to the best high-yield savings account you can find at 4.5%, you earn $900 before tax and around $657 after. If you move it into a short-term Treasury ETF yielding 3.95%, you earn $790 before tax, but because state taxes do not apply, your after-tax return in many states ends up being higher than the high-yield savings account. Now, 3 of those numbers are for $20,000. Imagine the difference on a larger amount. On $100,000, the difference between Maya's path and the direct Treasury path is potentially thousands of dollars every single year. Money that was always yours, money that your bank was collecting on your behalf and keeping most of it. The knowledge required to change this is not complicated. It does not require a financial advisor or a brokerage license or any kind of special access. It requires opening a standard brokerage account and buying a single fund that holds short-term government bills. That is the entire difference between being the middleman's customer and being the person who cut the middleman out. Maya was responsible. She saved her money and followed every piece of advice she was ever given. Jordan was informed. He upgraded his savings account and felt like he had beaten the system, but neither of them ever stopped to ask what the bank was actually doing with their money. And that one unasked question was costing them both hundreds of dollars every single year. The smartest financial move you can make is not finding a bank that takes a slightly smaller cut. It is understanding the system well enough to step outside it. Your savings are not just sitting in a vault. They are working hard every day for your bank. The question is whether you are going to let that continue or whether you are going to be the one who keeps the return. Run your own numbers, look at your tax bracket, look at what your savings account is actually paying you after tax. And then ask yourself if you are ready to stop being the cheap rent in someone else's business model.